What's up everyone, it's Karthik with MoneyVest. So this is going to be your market update as the NASDAQ sells off a little bit over 3.4% on the day. We have the S&P 500 down almost 3% and the Dow Jones down over 1,000 points, over 2.6% on the day. Thank God the day's over. We had a 2-hour market open live stream. I had a couple updates in between explaining volatility and really asking you guys, are you buying, selling, or holding in this market environment? We've got lots to discuss. Right now, I'm going to explain to you a slow-moving currency crisis that we are facing at the moment, while also having a fast-moving global margin call. And this is not something to be taken lightly. I think it's a pretty serious market occurrence, and nobody at the end of the day really knows how long or how severe this market sell-off is going to be. We're still in the middle of this market sell-off, so just because the markets recovered a little bit after the market opened and volatility hit a peak of 60, which we also discussed in our previous video. So if you come over to the volatility here, we hit our highest level since March of 2020. It's not over yet. Okay, I want to be very clear. It's not over yet. We're not fully out of the woods because we're still trading within the context of a lower high and a lower low. So take it day by day. Try to understand, what's going on with the market and what's happening with the currency crisis that I'm going to explain in this video, as well as the global margin call that we are also witnessing in front of our eyes, as over $1 billion worth of crypto was liquidated in the last 24 to 48 hours. So this right here was Binance Square. YG Crypto has over 25,000 followers. $366 million liquidated in crypto market meltdown. In a stunning turn of events, the cryptocurrency market has witnessed a massive liquidation of $366 million in the past 60 minutes. This was 17 hours ago. As prices plummet, traders are left reeling from the sudden downturn. Binance also reported, in fact, actually Bitcoin plummets to 50,000, over $1 billion leveraged positions liquidated. This was not Binance. This was actually on data from CoinGlass. So CoinGlass data shows that a sharp decline has resulted in massive liquidations across the market, reveals over $1 billion in leveraged positions were wiped out in the last 24 hours, with long positions accounting for over $900 million in total. So this is quite literally the tip of the iceberg, because we are seeing a significant amount of margin getting rinsed out of the market, right? So think of it, the markets are really just shaking the trees. That's what they're seeing, kind of shake the trees and drop all the dead leaves. In other words, the leverage out of that system. And Tom Lee also mentioned in an interview with CNBC that over the weekend they had some analysis done to figure out there's over 700,000 accounts liquidated in crypto as well. Not to mention there's also margin calls happening over on the equity market. So before we get any further into the video, I really want to mention everyone that I've got my full 37 stocks and ETF shopping list. So if you want to get access to this private members only video, as well as all the trade alerts, as well as analysis on a lot of different data points, and our entire Patreon members only videos and our MoneyVest platform, links going to be down below. I've opened up a few more spots because a lot of you guys have been reaching out to me to open up a few more spots. So I've opened up 4 or 5 more spots here with a 16% annual discount that's available until the end of this month. So if you want to take advantage and watch this entire video, figure out what my buy targets are on individual stocks as we are witnessing this selling pressure, links going to be down below. We'd love to have you on board. So now let's talk a little bit about the currency crisis with the carry trade, as well as the global margin call as it's happening live. So here's the complete overview of what exactly is going on with the carry trade. And hopefully this gives you a very good idea and an understanding of how this all plays out. This is a slow burn. I want to be very clear that this is arguably a slow-moving currency crisis with a very fast-moving global margin call. So what really happened was, as Japan kept interest rates low, because they didn't really need a reason to raise interest rates in the first place, because they were dealing with a lot of deflation, stagflation, whatever that might be, they were keeping interest rates near zero. And the Japanese yen continued to depreciate against the US dollar. As I've showed you earlier, the Japanese yen continued to devalue in its currency against the US dollar. US dollar continued to appreciate against the yen. So that creates an opportunity, right? Because interest rates are low and you've got a depreciating currency. So what traders did, essentially borrow the yen borrow in yen at low interest rates. So those are two really important factors to understand, is that traders, investors, even globally and over in Japan, borrowed in yen at low interest rates, and then they used this borrowed yen to buy US dollars. Okay? So they used the yen to buy US dollars and then invested those US dollars into high yielding US assets, could be stocks and bonds. So that's how it all started. With a lower yen depreciating against US dollar, low interest rates, they bought yen. They essentially borrowed in yen and then bought US dollars with those yens and then invested in high yielding US stocks and assets. So the best case scenario for these traders was that the yen continues to weaken and depreciate against the US dollar. That is good news, because if they have borrowed in yen, their debt is financed and fixed in yen, and their US dollar, which they bought using the yen, is appreciating against the yen, right? So that's a good news. That's the best case scenario, because whatever they've borrowed continues to be fixed and financed at very low interest rate, and whatever they've invested in, not only the currency that is appreciating, but also the investments they've made in US Treasury bills, treasuries in general, stocks, AI stocks, whatever it might be, right, in the US market. So that's a double win for this carry trade, because that's a best case scenario, right? So you borrowed cheap, invested high interest rate, you make money on both the rate differential because you're borrowing cheap, investing in high yielding assets, and also the currency conversion, because the currency that you're borrowing in is appreciating against the currency that you've bought, which is the US dollar. So that's the best case scenario. Now, the reason why this problem accelerates quite aggressively, and this is the worst case scenario, is because Japan needs to stabilize the yen. Why? Because no country wants a depreciating currency. Think about it. No country in the world would want their currency to depreciate against the US dollar. Since the US dollar is the global reserve currency of the world, most countries are trying to stabilize their currencies, especially if you are a currency that imports one of the most important commodities in the world. So every country wants to make sure that their currency is stable. So no country wants a depreciating currency. No country wants an expensive import, since the US dollar is the global reserve currency and the trade currency of the world, and the most important commodity is oil. And this is where the problem begins. Japan imports 97% of oil due to insufficient domestic production. They don't make enough oil. So that's why 97% of it they import into the country for people to use, for companies to use, for businesses, for them to manufacture, for it's their energy. Oil is one of the most important commodities in the world. It's energy. So since they are importing 97% of oil, and oil is the tradable currency for oil is US dollar, and yen continues to depreciate against the US dollar, what happens? It becomes more expensive for them to import. And at the same time, if oil prices continue to go up, whether it's crude oil, Brent, if it continues to go up, so that's a double whammy. That's a double risk for Japan, because oil becomes more expensive and yen continues to depreciate. So oil to yen ratio continues to worsen for the country. So what do they need to do? They need to stabilize the yen, because they cannot control the prices of oil. Japan can't control the prices of oil. They can only do something with the yen. So Japan can only try to control the yen so that they can stop the bleeding in the yen. So what do? It's anticipated, of course, they do increase interest rates by 25 basis points. And at the same time, they also start buying yen to support the demand, right? Because they need to create demand somehow so that there is some stabilization in the currency. So they start buying yen. And how do they do that? Where do they get the money from buying the yen? Which, again, when they start buying it, it starts to push yen higher. And that's when the carry trade starts to fall apart. Because remember when I told you earlier, the best case scenario is that both interest rates stay low and yen continues to depreciate against the US dollar, right? So the traders that borrowed the money make money both on the rate differential plus the currency conversion. The currency conversion trade-off goes away as soon as the yen starts to increase in value, which it did. It's up over 13% against the US dollar in the last 2 to 3 weeks. And BOJ also raised interest rates at the same time. So that interest rate differential also, that spread minimized a little bit in the last couple of weeks after BOJ increased interest rates by 25 basis points. So So that's where the carry trade starts to fall apart, right? So their double win over here, which was the rate differential and currency conversion, becomes a double whammy, becomes a bit of a problem here. And so what does BOJ do if they want to help support the yen and create that demand and start buying yen? They start to essentially dump US dollar and may even US treasuries to obtain dollars to buy yen. But before we get there, I do want to explain the carry trade. So yen appreciate against the US dollar, as we discussed, as the BOJ steps in to help stabilize it. Traders who borrowed in yen need to liquidate. Okay, that's the carry trade falling apart, is that they need to liquidate their positions, whether it's treasury bonds, stocks, whatever it is that they bought with those cheap yens. They need to liquidate, and they need to liquidate because they're worried about the currency conversion loss as yen appreciates against the US dollar. And banks who lent traders yen start calling in on their debt as margin requirements change because the yen is increasing against the US dollar, and that creates a global margin call for all traders, all investors who borrowed cheap yen to buy US dollar and US dollar denominated assets. So yen appreciating against the US dollar is creating this global margin call. The second thing which I wanted to go over is how does the BOJ or how does the Japan, really stabilize yen in the first place, right? So they need to buy yen. And how do they do that? They dump US dollars, and they may even dump US treasuries because they are one of the largest holders of US debt of over $1 trillion is what they own. And so if they start dumping US dollars and US treasuries to obtain the dollars to then go out and then buy yen, that's one of the ways that they can stabilize the yen from bleeding further. And this is all happening at the same time that global markets all over the world, capital is flooding to bonds because there's flight to quality, there's flight to safety, right? So at the same time, global markets are becoming more defensive. So what do they buy? They buy US treasuries and they dump stocks at the same time that the BOJ is dumping bonds. So what's really happening is the world is buying what Japan is dumping. Example, the US dollar and the US treasuries, as they are offloading this off of their balance sheet to get rid of US dollars to buy yen to stabilize their currency. The world is becoming defensive as there is a margin call that's happening right now, and everybody's selling equities and they're moving into more defensive assets such as fixed income, such as bonds. So really there's a tug of war on US treasuries. And that's actually one of the reasons why we haven't really seen the US treasuries spike, the yield spike, because if BOJ is trying to raise US dollars to then buy yen, they are selling US dollars and they are selling US treasuries to obtain US dollars and then to buy yen. But there isn't a yield spike here. Why? Because that supply is getting absorbed by the other parts of the market globally as the entire world becomes more defensive. So really it's a combination of a slow-moving currency crisis that's in play with a fast-moving margin call. So the fast-moving margin call, as you'll notice, which is the latter part, is happening much faster as what we have seen in the markets, as the selling pressure is very, very quick. There's a lot of liquidation. There is a lot of accounts getting margin called. And there's also a slow-moving currency crisis happening at the same time. So that is the combination of what we are experiencing at the moment for the world. And how much is the carry trade? You might be wondering. So how much it is that the traders and investors have borrowed? So how big is this carry trade to begin with? Well, it's over $20 trillion. That's the expected number. This is the Deutsche Bank study. So Deutsche Bank's report extends that scenario to include the Japanese government and its balance sheet. Japan's $20 trillion carry trade poses risks amid central bank's policy shift. So Japan's government is engaged in a massive $20 trillion carry trade, the funding of loans and foreign assets by borrowing low-cost yen, that could bring unexpected risks if central bank tightens policy, Deutsche Bank analysts warn. And this was just a few days ago, before the BOJ decided to raise interest rates. Using research by San Francisco Federal Reserve and International Monetary Fund, Deutsche Bank's head of currency research, George Sarvelos, analyzed a consolidated balance sheet of the Japanese government, including the government-run pension fund GPIF, the Bank of Japan, state-owned banks, showing asset liability mix of its $20 trillion debt. $20 trillion debt is what we're working with. That debt, Deutsche Bank found, amounts to an enormous trade invested abroad at high interest rates and funded by low-rate short-term borrowing in yen. So as I said, traders borrowed at low interest rates in yen to buy dollars to then invest at high interest earning yields of US treasuries and stocks, whatever they might be investing in. As expectations grow for the Bank of Japan to exit its ultra-loose monetary stance, Deutsche Bank's report says it's crucial to understand the potential consequences of this huge trade, not only on the government's balance sheet, but on savings and assets held by households. The yen has traditionally been a favorite funding currency for carry trades because Japan's low interest rates and market participants expect investors globally to unwind hundreds of billions of dollars in such trades if and when the BOJ exits its ultra-easy monetary policy. So once they decide, which they have now, that we need to stabilize the yen somehow because it's becoming too expensive for us to import oil, they're going to unwind on this ultra-easy monetary policy. And when that happens, of course, it creates this falling apart of this currency, falling apart of this carry trade, which creates this slow-moving currency crisis as well as a fast-moving global margin call. So that's the overall breakdown of what is going on. So as you might have imagined, $20 trillion is a pretty significant amount. And, if that Deutsche Bank report is true, this could very well be the beginning of something much bigger. And that's exactly why I mentioned in the beginning of the video that we're not out of the woods yet. I think this is something that we need to be very careful with. And of course, take it day by day. Volatility did retrace a little bit back higher to over 39. From its lows of back of 30. So it did increase 26% towards the end of the day, towards market close. But then, of course, it did drop over 52% at one point, and it finally closed down 43% from its peak of well over 65. If you come take a look at some, S&P 500 and the NASDAQ, this is the overall structure where we are still making lower highs and lower lows. You'll notice that we did rotate back lower. We did try to fill some of that gap, but we're still left with plenty of gap in the 5300s. And then we rotated back down towards the end of the day. And this right here is still the overall lower highs and lower lows on the S&P 500. And NASDAQ here also on a very similar trajectory. As you can see, the QQQs continue to trade inside this downtrending channel of lower highs and lower lows as well. We got a big resistance to watch out now in the $445 to $454 a share for the NASDAQ, for QQQs. Now, coming over to some other updates. So moving forward, this right here is the dual mandate. And, apart from the currency crisis, apart from the margin call crisis, there's also, a lot of fear related to a recession over in the US. But I want to be very clear, and this is something I mentioned in the live stream as well, that if you look at the economy on a more absolute basis, yes, we're seeing unemployment accelerate to over 4.3%. And I'd be the first one to tell you that the Federal Reserve should have lowered interest rates sooner. And we wouldn't have seen such an acceleration in unemployment with over 7 million people unemployed. However, on an absolute basis, we're still okay. This is not a level where people need to panic over a potential recession in the US. Unemployment is still, on a relative scale, lower compared to what we have seen before. Yes, it's moving higher, so I guess the trend is more important than where we are now. But at the same time, this is not a level where we need to panic around a recession, right? We're still yet to see if a recession even happens or not. I mean, of course, the probability is much higher, but on an absolute level, we are still at a much better place than what we have experienced in previous recessions. So this, I explained this during our Market Open live stream, and what this essentially shows us is where we currently are in the dual mandate bullseye, which is, this is where the Federal Reserve wants to be. That's the place that they want to be in, at just over 4% unemployment and inflation stable at 2%. That's core inflation. But unfortunately, they're much, much higher. They're well over 3%, closer to 3% on core inflation, and they're also accelerating higher on unemployment, as we witnessed last Friday. So that being said, I mean, there's three potential outcomes where we could head to. And comment down below. I really want you to pause this video and comment down below as to where you believe that this is headed. Are we going to see higher levels of unemployment? If so, how much? And is that going to put an impact on inflation as well? And if so, how much? Are we going to see inflation come back down? Because the ideal scenario is in green. This is what the Federal Reserve is praying and hoping for, that they lower inflation without really affecting unemployment or the economic growth, and that's the quote-unquote soft landing. But if we move sideways, more towards the right, while staying elevated on inflation, that's the worst place the Federal Reserve can be in, because then we will be between a rock and a hard place. Then they'll have to make a very difficult choice of whether to raise interest rates, lower interest rates, or keep them where they are. We don't know. And my guess is that if Jerome Powell is who he says he is, and he's taking a chapter from Paul Volcker's book, then I'm gonna assume that he's gonna try to control inflation first, figure out the economy later, than as opposed to giving in on the political pressure and all the other types of pressure for rate cuts. Because inflation is going to be a much bigger problem to fix than unemployment. Unemployment can be fixed rather fast if they were to lower interest rates fairly quickly, but inflation takes a long time to really get it down. As we know from Paul Volcker's time back in the 1970s and 1980s during great inflation, they had to increase rates 3 times and double digits in order to really break inflation and bring it down to sub 2%. And again, since then, we have really seen really muted levels of inflation until, of course, the pandemic of 2020. So these are the 3 potential outcomes. Let me know where you believe we are headed. Another outcome is, of course, coming down on inflation, but still accelerating on unemployment. This could still be an okay scenario where at least inflation is coming down, and eventually they can figure out a way to control unemployment, and they can lower interest rates. They can provide with some quantitative easing to bring unemployment back down. But these are the 3 potential scenarios when it comes to the dual mandate. So let me know your thoughts down in the comment section below. So coming over to the market, this was the heat map, folks, and this looks absolutely beautiful. If you didn't buy stocks today, I've got a question for you. What are you waiting for? Like, seriously, what are you waiting for to buy stocks? Like, how red does this need to be in order for you to feel comfortable in deploying capital? And I'm not even saying that you have to go all in, but ask yourself, like, what is going to be the right time? There's never going to be a right time, because when market starts falling, they could keep falling. There's this consensus view where if prices are coming down, people expect them to come down even more. When prices go up, they expect them to keep going up. So that's the recency bias. So you have to avoid that and really figure out when the risk reward is good, when volatility is high, when there's a lot of really good deals and look good bargains here on the markets here. You got to take action, right? You got to take action. And that's what I did today. I deployed up over $15,000 in stocks. I think I was down still close to $20,000 on the day. But yes, I took advantage and of course bought on the day here. This right here was ETFs. So as you can see, that inverse ETFs pushing higher, they were the ones that were green very much. Volatility ETFs were green, and all the money, all the capital is flooding to one direction, folks. It's all flooding to one direction. As I mentioned earlier, during the crisis, the currency crisis and the global margin call here, as capital is flooding away from equities over to the bond market. That's where it's going. As you can see, that everything red is moving towards one direction, and that is the bond market, the fixed income market here, as TLT, TMF, BIL, IEF, everything is green or somewhat green, so mostly flat to green here, as everything is becoming more defensive. Markets are becoming more defensive, investors are getting more defensive, and as the Japan is essentially dumping and offloading some of that US Treasuries, guess who's absorbing it? The entire market. So there's a lot of capital inflow over to the bond market right now. This right here is all the sectors, all 11 sectors in the S&P 500 down over 2 to as much as almost 4% in the last 1 week. Utilities is the only sector that has done well, up over 26 basis points. And in fact, all industries are down except for just a few of them. They're all selling off on the day. A few interviews that I highly recommend that you check out. The first one from Josh Brown talks a little bit about Buffett selling Apple, and definitely got a signal there. And then also talking about the VIX hitting a high of 60, highest level since the pandemic. And then Dan Ives also talking about how the AI bull run is still intact. There is opportunity in the market, and it's just kind of having this moment of walking their clients, kind of holding their hands right now during this selling pressure during this entire panic and fear and the state of the market, and they do still believe that this is not the end of the bull market, the tech bull market that they have witnessed over the years. So those two interviews, really highly recommended. Tom Lee was also there on CNBC, so check that out as well. We're gonna get a little bit more insight into what's going on with the entire market and what their views are on the entire market as well. I mentioned everyone, MoneyVest index is at 2.85. So again, we are now in the green zone. That's a very clear signal for me to start deploying cash and dollar cost averaging, and that's exactly what I did in the markets today. A few more things I want to mention here is the Magnificent 7. So this was over a weekend video that I did for Magnificent 7. And if you come over to the charts and take a look at where the Magnificent 7 is right now from its all-time highs. So if you scroll down a little bit, this right here is the index trading at just over 1,700. We did see some buying pressure, buyers stepping in intraday. We are down a little bit over 16% from all-time highs. At one point, we were down over 20% from all-time highs. And if you come over to our analysis, I've mentioned that the Mag 7 index now down almost 18% from all-time highs. Remember, as per our analysis on Mag 7, once it breaches the correction territory, down over 10% from all-time highs, it accelerates to an average and median loss of 23.6% and 19% respectively. So we were down 20%, so we were right in the middle of that range that we anticipated this Mag 7 index is going to be down. So that's the 23 to 19%. Now, does that mean that we are now back to all-time highs and this is it? That was the bottom, and we are now back to a reversal? Nobody knows. Again, nobody knows. It's just understanding probabilities, understanding risk and reward, and taking advantage regardless of whether the markets are heading higher or lower. When you see deals, when I see deals, I buy. Plain and simple. I don't try to predict. I look at historical data, I study statistics, and when I see the probabilities in my favor, when I see there's good risk reward, when I see there's good opportunities, I simply dollar cost average. That's it. Okay, so coming back over to the markets, and there was also massive amounts of uninversion in the yield curve. We uninverted for the first time in over 2 years. We were up to as much as 1 basis point positive, and we are now back down over 21% lower to negative 11 basis points. So we were uninverted for a very brief moment, first time in over 700 days. Volatility here again continues to be at just over 38, as we discussed earlier, and crude oil trading at support here inside this green rectangle, sitting roughly at around $72, $73 per barrel at the moment for crude. Indices and indexes and ETFs we've already covered. S&P 500, QQQs still within the context of a downtrend, lower highs and lower lows. So I think that's really important to remember that we're still very weak from a technical analysis standpoint, and we're not out of the woods yet. Coming over to Apple, I think all stocks got bought up here fairly quickly. Apple, we had marked down a support at around 197, and you'll notice that intraday, it had buyers stepping in, well over 7.5% gain intraday here. So lots of buyers stepping in intraday to push back up, only down about 4.8%, so definitely showing signs of progress. And of course, buyers stepping in here. If you come over to the 30-minute chart, you'll notice that very similar to S&P or the NASDAQ, we have seen Apple also within the context of a downtrend as it pushes higher and then, of course, gaps down quite heavily once again. So it was making a little bit of a higher high and higher low pattern, then a huge gap down, then got bought up, pushed up quite aggressively here intraday, and then selling off towards the end of the day. Support levels now is going to stay put at $206 down to as low as $197 for Apple. Talking about Amazon. So Amazon here on the day also, of course, is down over 4%, but again, not as crazy as some of its other peers in the Magnificent 7. Resistance is going to stay put at 166, so that's the level that we're going to be keeping a close eye on, and support level is going to stay put inside this green rectangle. We were on the cusp of making a right shoulder, but Amazon was like, screw it, I don't care about my right shoulder, I'm going to break down the neckline anyway, and it broke down below 166 in just the last couple days, and that's going to be that resistance next to watch for Amazon, to the support level sitting in the 140s. Talking about Tesla, and Tesla here also selling off, but getting bought up intraday. Once again, you're seeing buyers step in intraday for these companies, and Tesla 184, 185, that's the support level that we marked out in our previous updates. That's inside this green rectangle, as you can see over here, and resistance is going to stay put all the way up to $208 a share for Tesla. Support level, like I said, it's going to stay put roughly in the 180s. Talking about stock of the day, NVIDIA at one point was trading down to as low as $90, very close to my CSP strike. I have a cash secured put on NVIDIA at closer to $90, but I did pick up some NVIDIA anyway, pushing up over 12% from its lows to close back above $100. And support level is going to stay put at $96 a share. So congratulations if you did pick up NVIDIA today. So congrats if you were able to buy a lot of these companies at their lower point here at market open. So that's smart of you. That's a good call if you were able to pick up shares when the VIX was high enough, well in the 50s and 60s. So pat yourself in the back, because not a lot of people can do that amidst all of this weakness and all of this fear and panic. If you were able to take advantage, that's your edge right there. You were able to stay calm and rational and composed during the markets selling off quite aggressively around you. And it kind of ties well between Stoic philosophy as well. And this is something that I mentioned in the live stream as well. Really in the markets, you want to be like a rock, okay? You know how a rock that's placed right in the middle of the ocean, and you've got waves crashing all over the place, right? You've got waves crashing over the rock, around the rock. There's so much chaos around that rock with the waves crashing over. But what does the rock do? It holds its ground. It is stable, it is steady, it is calm, it is unwavering and unmoving. It is rational, right? And that's how we want to be when it comes to investing in the markets. There's going to be chaos. There's going to be a lot of chaos and a lot of distress around you. You can read the room, you can see the panic, you can feel it, you can see it on your screens. But what do we need to do? Stay calm, stay composed, look at the markets objectively, understand what's going on, and take precise decisions that you can be proud of in the future. So there's no point rushing into anything. Be calm, be patient, and let the prices come to you. You're not chasing, you're always attracting. So anyway, enough Stoic philosophy here. NVIDIA down 6%. Support level is going to stay at 96, and next resistance all the way up to 118 for this company, of course. Talking about advanced micro devices, and AMD perhaps the only stock that closed green among these stocks here, FANG Mint companies. So very, very nice move to the upside. It did gap down quite heavily down to 120s, and then again pushing back up to over 1.75% higher. Support level is going to stay put at 130, down to as low as $118 for advanced micro devices. Coming over to PayPal, and PayPal here on the day also selling off quite aggressively here, down a little bit over 2.5%. Support level is going to stay put at $57. And again, resistance all the way up to $65 to as much as $68 per share. Triple, quadruple top for PayPal, back in that green zone of consolidation and area of stabilization for PayPal, as it has been trading at those levels for a really long time. Talking about Visa, and Visa, for the right reasons, is selling off from this resistance, as we discussed in our previous updates. Lower high and lower low pattern. So this right here is the overall pattern for Visa. Support level is going to stay put at 249, 250s, with a resistance all the way up to 266 for Visa as well. So lower highs and lower lows for this company. Talking a little bit about Meta platforms, and Meta here also just down about 2.5%, but getting bought up intraday. Still within the context of this yellow rectangle support level inside this green rectangle, inside this green demand, 420 as much as 458. Another really important support level. Resistance all the way up to $540 for Meta as well. Talking about Google, and Google here on the day down over 4.6, so selling off below this area of support, which will go ahead and turn this level into a resistance now. And the next target of support and sitting in the 150s for Google inside this green rectangle is where the next area of demand and support is going to be. But we are incredibly oversold for Google, as we are for a lot of companies. I'm assuming NVIDIA coming down to pretty oversold levels, Tesla coming down to pretty oversold levels as well as Apple here, and even Amazon. Apple RSI over 38, MACD, L3 banker oscillator, everything selling off, with Amazon also very oversold right now. As you can see, the RSI 26, MACD, L3 banker oscillator, just down to oversold conditions. Going over to Microsoft, and Microsoft also, take a look at RSI 24. MACD's been down, L3 banker oscillator just been getting exhausted to the downside, and we are now in the area of demand inside this green rectangle. I could pick up some Microsoft tomorrow, so I could see myself picking up some of this company going into tomorrow, or maybe even sell some CSPs at these levels. But yes, it is also down in a correction, down a little bit over 16-17% from its all-time highs. So now trading down to that green rectangle, that area of support for Microsoft, with the resistance all the way up to $432. Coming over to Enphase, and Enphase here getting bought up from its lows of $100. $96 is where it ended up trading at. This right here is the area of demand inside this green rectangle with a resistance all the way up to as much as 138 to 141 for end phase. A lot of consolidation sideways in that range, similar to what we've experienced with PayPal. Coming over to Netflix, NFLX, and Netflix here also getting bought up, so traded down to as low as 587. Back above that support of close to 596, close to $600. Again, oversold on the R side, the MACD and the L3 banker oscillator. Next resistance and targets back up to 637, 638 for Netflix. Finally, coming over to Costco, and it's been on a slow and steady ride lower. Support level is going to stay put down to 785 for Costco, with a resistance all the way up to $838 a share for this stock. So hope you all enjoyed this update. And again, do join our Discord and our Patreon if you want to get access to the entire MoneyVest platform. Let's take a look at the earnings calendar. A lot of companies were scheduled to report after the bell. And then later this week, we've got Caterpillar, Airbnb, we got Fortinet, CVS, Shopify, Monster Beverages, Take-Two Interactive, Eli Lilly, we got Disney, Amgen. A lot of companies are scheduled to report earnings. So don't take your eyes off of earnings either. That's also very, very important. So hope you all enjoyed this video, found it helpful. Make sure you drop a like and subscribe to the channel. Please do share these videos with your friends and family. I would really appreciate that. It helps the channel grow. And as always, happy investing. I'll see you all in the next video.